Hi everyone, let us learn the concept of activity ratios. The activity ratio is one of the important classification of ratio analysis which is used to analyze the financial statement of the business. By using the activity ratio, a business can analyze their financial statement matters and their efficiency of the assets management and the profitability concern, etc. Let us discuss the meaning of activity ratio in detail. The activity ratio, which shows how effectively a firm uses its available resources or the assets to generate revenue or cash. From this explanation, we can understand that an activity ratio which is used to measure the efficiency of the concern for using their resources or assets for generating revenue or cash. Also, it helps to analyze the efficiency of the management for managing their assets. Okay, and also it helps to measure the speed of its turnover or the speed of conversion of assets into cash. The activity ratio, which is also known as performance ratio or asset utilization ratio. By using the activity ratio, we can analyze the financial statement and we have to interpret the result. Based on this interpretation, the management can took the decision for their operational purposes. By using activity ratio, the business concern can measure their efficiency of the operations or asset management. It can be interpreted that if we get high the ratio, it indicates the better use of resources, so it will result the higher profitability. If the ratio is low, it indicates the inefficient use of resources. Okay, the activity ratio is expressed in number of times. We know that the ratios are expressed in different terms. In the case of activity ratio, it expressed in number of times. In times, it indicated. Next, we have to look what are the classifications under activity ratio. Basically, 5 activity ratios are there. First one, inventory turnover or stock turnover ratio. Second one, debtors turnover ratio. Third one, creditors turnover ratio. Then fixed asset turnover ratio. Finally, working capital turnover ratio. Okay, we have to discuss each and every one in detailed manner. First of all, we have to look what you mean by inventory turnover or stock turnover ratio. What is the formula used for calculating this ratio, etc. Okay, let us learn the term inventory turnover ratio. The inventory turnover ratio, which shows the relationship between cost of goods sold and the average inventory. Then it is also known as merchandise turnover ratio. By using this formula, we have to calculate the inventory turnover or stock turnover. We know that the inventory is a stock, is one of the current asset held by the company. The inventory turnover ratio is a measure of liquidity of inventory, which ratio measure how quickly the inventory is sold, and it can be used to test the efficiency in the inventory management. Also, we can say it used to measure the speed of convertibility of the inventory into the cash. Okay, the formula is stock turnover ratio is equal to cost of goods sold divided by average stock. We can see that there are two components are there, cost of goods sold and average stock in the formula. Okay, the cost of goods sold can be calculated by using this formula, that is opening stock plus purchase plus direct expenses, that's including the wage minus closing stock. Also, we have to calculate cost of goods sold by deducting the gross profit from the sales. Okay, then next component is average stock. The average stock is calculated by using opening stock plus closing stock divided by 2, this formula. And next we have to calculate the velocity, stock velocity or the stock turnover period. Okay, we know that the stock turnover ratio is expressed in times. When we have to calculate the result in a days or months basis, we can use this form to represent the ratio in days or months. Okay, the formula is for the calculating stock velocity or the stock turnover period of inventory turnover ratio. Okay, it's equal to number of days or months in a year, that is number of days 365 or the months 12. Okay, divided by stock turnover ratio. We already calculate the stock turnover ratio before. By using that result of stock turnover ratio, we have to find out the stock velocity or stock turnover period. Okay, from this formula we have to apply the directly to the main equation. For that, we have to make use of this formula is stock velocity or stock turnover period is equal to average stock divided by cost of goods sold into number of days or months in a year. We know that number of days means 365 days in an year, also months 12 months in an year. Okay, so we can say the stock velocity or the stock turnover period is equal to average stock divided by cost of goods sold into 365 or 12. Okay, this is a concept related with the stock velocity or stock turnover period. Okay, then next we have to look the interpretation part of inventory turnover or stock turnover ratio. It indicates a higher turnover ratio or short the period of inventory turnover, which indicate the inventory is sold very quick, and it indicates the good inventory management system followed by the business. Also, if we get the result is very low, that is low turnover ratio or longer the inventory period, which indicates that the stock is dumping in the business or dumping in the godown of the business. It takes long time to convert the cash. The ratio is very low. It indicates the inefficiency of the management of inventories. Okay, this is all about the activity ratio and the first part of ratio, that's first classification of ratio, inventory turnover ratio. The rest of them we have to discuss in next lessons. Thank you.